And more immediately, in the meantime, this structurally bullish development, really, that we just discussed, flies under the radar of the COMEX-centric specs, who, unlike the commercial market makers, are blinkered to the effect of Basel III NSFRs.
Andrew, this sounds like a very positive development for the physical gold and silver markets. Can you tell us what you think we should expect in the very short term here?
Yeah, Shane, and again, it's one step at a time. And as we know, the paper market unwind is a process. And more immediately, in the meantime, this structurally bullish development, really, that we just discussed, flies under the radar of the COMEX-centric specs, who, unlike the commercial market makers, are blinkered to the effect of Basel III NSFRs and have on the long, obviously these first-tier banks that are also managing COMEX and over-the-counter positions, they know that they're having to, that anything that doesn't fly into an ETF, they have to back up with physical to back up a COMEX short hedge. That's a big change. In other words, we have not just empirical evidence that these over-the-counter loans are increasingly physically delivered. It is necessary condition to protect actual banks and liquidity providers from being exposed to another March 2020-like EFP event. And for this to happen, the already divergent price, EFP price, must begin to align with real physical supply-demand metrics. There's only so much that can go into the ETFs. And right now, the ETFs are the only paper flywheel keeping the exchange for physical conduit balanced in inverted commas, into backwardated futures spot positions, meaning, again, that the futures price is actually lower than the spot price. Just when refineries are tight for supply. One has to give one's head a shake to even question this. And as far as gold and silver are concerned, with sovereign buyers competing for one source of physical supply at a deeply undervalued price, there's a potential risk of another EFP blow-up. And if the paper gold price does not rise from here into such tight physical demand conditions, and we draw attention to it multiple times, when this EFP starts to threaten another blow-up. I mean, the last time this happened in March 2020, let's not forget that the short covering scramble that ensued when COMEX went bid only, it broke trendline resistances, it forced delta hedge futures buying, short covering, and it really set up a $600 rally, driven by this inability to deliver physical bullion. That's why they are making sure that these over-the-counter positions that are not flowing into an ETF are backed. And as we assessed in our January 25th episode, it was very short term, we expected some capping. And then during February and into the first quarter, we should evidence a physically driven rally commence in both gold and silver. Now, we're currently evidencing a coiling market ready to explode to the upside. Now, if the BIS was to overcook its price capping efforts into the end of the February over-the-counter OPEX expiry, they're going to run this ETF flywheel to a breaking point. And not to forget, while these the ETFs provide the ability to settle undeliverable COMEX positions run by the central banks, there are real global buyers, including Russia and China, who are going to scoop up what bypasses this flywheel or what it chucks out. In other words, spot prices flowing into the EFP over-the-counter markets will be physically bought.
And finally, Andrew, of course, my favorite topic, silver. Can you just touch on what's happening in the silver markets?
Shane, I know you can't contain yourself. The word silver, the look of silver, I'm sure that it's shining in your face right now. when it's important, when you weigh this action, I mean, it is this, to me, what's so interesting about silver, you can't hide the footprints. When you weigh this action up against a very tight, strong demand physical market, which, as we reported 1 month ago on the 10th of January, European and Swiss refineries were being forced to severely constrain gold supply due to this Omicron-related worker shortage. And as we reported last time, European and Swiss silver refining over the last month ground to a complete halt. Obviously, it's more effective, it's more to employ your resources to more profitable to refine gold. Silver came to a halt. These constraints actually still exist. not that the price evidences yet. So in the midst of this shortage of wholesale supply, in the last episode, we drew to the SLV ETFs refusal to buy what turned out to be really 2 days. And it was, I think we reported on day one, and it was 280 tons, and then there was another 75 tons, and it was over 350 tons of SLV inflows on the 24th and the 25th of January into such tight supply. Now, in current refiner staff conditions, had the ETF fulfilled its obligation to back these unallocated silver inflows with physical, it would have driven spot silver bid only and spiked silver at a minimum into the mid to high 30s, actually probably even higher. Now, the fact that silver price actually declined over $2.50 from the 24th of January to February the 3rd, at 21,985 was the low, which was mind-blowing because the spot price never even did not breach the 22 level, into an extreme shortage of physical supply and soaring refiner premiums. It's an absolute farce. And it's really not gone unnoticed, though. Every source to buy silver has been tapped into. It's dry. Not even Credit Suisse has any wholesale silver bars for sale into this tight supply, even when offering to pay large premiums. So COMEX-centric specs are completely blinkered to underpinning supply-demand fundamentals. And they took the bait and began mindlessly targeting the 22 round number. And as a result, momentum-driven specs were severely wrong-footed into localized non-farm payrolls gaming. Now, obviously, they had the register rung on them directly afterwards. And as we just really discussed, commercials exposed to the physical market delivery obligations are hiding inside the SLV flywheel. They're reeling in specs one-to-one long against them. Well, and as I say, while March silver features took out this targeted spec long stops at the 22 round number, that was last Thursday, notably and no doubt missed by these blinkered casino players, spot silver did not breach 22. It was jumped upon massively by spot indexes, locking in spot for future delivery with a product that is no longer available to supply. Now, in the future, when students look back at how these markets were allowed to operate, they will see that the physical stackers were proved right. And the wrong-footed blinkered, led-by-the-nose specs, busy capping into algo-related bearish crosses, just mindless algos, not just had a religious experience, but they were left on the sidelines when silver and gold exploded. Now, silver's easier to read, and unlike gold, which can, if necessary, be able to tap into central bank supply to, let's just say, manage short-term imbalances into price ascents, there is no such above-ground physical silver to loan outside of the SLV flywheel. And what this is telling us is that every ounce of inflows into the ETFs are not backed by physical, and anyone who's using this investment vehicle is part of the problem. And this is why it's important to avoid empowering any of these malfeasant structures. Now, please make it known to everyone. Drop a line to the CFTC, copy in your clients and your brokers. These so-called investments and hedging ETFs vehicles do not represent or discover a real supply-demand price. In fact, they are the tool to suppress price by never allocating the unallocated inflows and outflows. So, Shane, to answer these subscriber questions, bringing us up to date as of today, which is Wednesday the 9th, our liquidity provider meetings last night strongly suggest that the PBOC has been an active buyer over the last 2 weeks, while the ban on Russian scrap gold that we reported in a prior episode has also served to tighten up available supply, exacerbating European and Swiss Omicron-related gold refiner constraints. So, immediate refiner constraints for refined gold have tightened up physical supply into central bank size safe haven physical demand. And the paper to physical exchange for physicals operate at the margin, and it only takes a small reduction of underlying physical supply into an increasingly Basel III compliant over-the-counter market to force long-standing OPEX bets to be short-covered or delta hedged, forcing the price to rise. This is exactly the churn we're evidencing under the covers of the smoke and mirrors COMEX-centric paper market action. So last words on this. To sum it up, as Robert Kiyosaki repeated multiple times on our December Live from the Vault episode, how much physical do you have? Now is the time.